In this video, traders, we are going to look at what are the clues that we can spot the difference potentially between a dead cat bounce off the lows or the start of a recovery. Stick around. Hey guys, well, welcome to you. Thank you for joining me. All right, so age-old question. Market's been hammered. Doesn't matter what it is. Could be a currency pair, could be a commodity, could be the indices. At the moment in time when I'm filming this, it is the indices. But when they've been hammered a lot, a market's been really beaten down, a stock's been beaten down, starts to lift up off the lows. One camp says this is the start of a recovery. The other camp says this is a dead cat bounce, I'm shorting into it. So let's look at some of the clues that I think are worth watching so you can make a decision whether it's a dead cat bounce or it's a recovery. Now, listen, nobody actually knows. We're never going to know for certain until after the event. And also one thing that I think is missed quite a lot is that many of these things are quite fluid. So it might start to be a dead cat bounce and start to revisit lows, but then things change and then it evolves into a recovery. Or it's the start of a recovery and then things change and the dynamic nature of the variables change and we go back to lows. So, you know, it's not a one size fits all, but there's some things that we can definitely look at to give us clues and to give us hints, and they make perfect sense as well. So scenario is market's been hammered down, market's recovering back up. Is it dead cat bounce? Is it the start of a recovery? Okay, so the first thing is, guys, is most of the time, you can go back and look at all the charts, most of the time, when it's something significant that's shocked the market, a V-shaped recovery isn't really the most likely scenario. Now, we have had that recently with little shocks, little mini shocks to the market in the bull market we've had these V-shaped recoveries. But if you go back a long period of time, big shocks tend to push lower on the extreme panic and liquidation. Then there's a push higher. Then people are like, you know what, I'm gonna peel some off, blah, blah, blah. And then we get just literally a lack of buyers before there's clarity. And that little bit of selling and lack of buyers causes them to drift lower. So we have this shock, the volatility movement, we have the bounce, we have this sort of stagnation and people wondering what's going on. Then we don't have the same level of brutal selling into the lows, but we just drift low, drift lower, drift low, drift low, take out lows. That's generally the theme. Now, you can't really say that's going to always happen because it doesn't always happen. Sometimes you do get these V-shaped reversals, but that's something to consider. But anyway, the other things to look at is kind of from a technical perspective or an operational perspective is how many days is the bounce? You know, if we're getting continual bang, 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 then the more it goes, 4, 5, 6 days, then you probably think it's a recovery. And you probably need to be not chasing it as such, but then at least waiting for the pullback to buy rather than the pullback to short into. Because, you know, the more days we have where you've got persistency of buying, then more you can assume supply demand has shifted. Now, it's not always the case, but it's a kind of rule of thumb. And I did a video which is probably on its way to being uploaded now, so make sure you obviously subscribe and all that good stuff, talking about the rule of 3. And the rule of 3 is that, especially in this kind of scenario, a 3-day bounce is probably normal, right? If you're getting a 4th or a 5th, then that's something to think about. So it's the one day, 2 days, it gets people in, because don't forget, guys, you've got to remember this. The market is there and it's trying to get as many people wrong-footed as possible. So the more the rally looks really strong and aggressive and good, the more people are going to be chasing and buying, and the more people are going to get then their faces ripped off as it pushes back to lows. So you've got to kind of think gaming theory. Okay, how are people positioning this? Are people really frightened about missing out from the recovery? And don't forget, if it is a recovery, you've got all this time to get it. You know, we're not trying to be heroes here. It can rally for 6 days, pull back, pause, and have a nice bull flag off the low. You can be like, great, I can quantify my risk and in my go. So we're not chasing anything. It's not missing out. But we kind of want to see how many days. You know, that's an important thing. 3 days, what's happening after the 4th day? Then, how far out of the range? Something that especially is quite pertinent now is that we've had this scenario where the market's kind of done this. It's probably, well, imagine it's done that, right? And these moves here are still kind of multi-thousand point moves in terms of the Dow. So it looks like a lot when you look at the daily change. Like, wow, it's up 1,000 points. Wow, it's up another 800 points. But the point is, guys, how far out of the range has it moved? Has it moved, like, are we still in the range? In which case, are we in the multi-week range? It looks like a lot from an absolute perspective, but it's not in terms of how far you go back. Or when we break out, how far do we go out? Are we just peaking out? And if you kind of looked further ahead and imagined that chart, could you imagine one of those big fat candle wicks on there that just is broken out of that resistance and looks absolutely like it sucked everyone in? If you can imagine that, then pretend that might be what happened. So how far out is it? Now, of course, if we're way out of the range, then things are changing slightly. Can it still go back to lows? Maybe, but you can see there's some strength there from go to here, break out twice the range. It's a different scenario. Or if it's just poking out the range on one day, maybe the start of a second day, and then you can think, hey, that would look like a really big kind of bull trap if we extrapolate that out and look back in time. So how far out of the range has the market rallied to kind of think, hey, is it recovery or is it dead cat bounce? So the next thing is news flow. So obviously in this situation, and also many situations, guys, there's catalysts that have caused this. You know, we go back to all the scenarios where any market has been hammered and has been really sold into. There's been some kind of catalyst. There's always, even though there might be an underlying thing if it's gone too far and too fast, but there's always a catalyst that causes the sell-off. So it's watching the news flow from that catalyst. If that catalyst is taken away, then you've probably got more chance of a recovery. If that catalyst is completely removed, then of course you can imagine, hey, the valuation is probably going to be similar to where it was in the sell-off. So that can change things. Now, in the case of the coronavirus, it's slightly different because we have the impact of the virus itself and we have the economic impact. So this is why there's a lot of unknowns with this, but it's worth thinking, okay, if the news flow is quite solid in terms of companies, individual companies, I think it's more important to look at those than the countries, the individual companies that make up the index or whatever you're trading. You know, if they're saying, hey, it's not as bad, you know, we're not going to do, and we don't know that yet, and from right when I'm filming this, we don't know that yet, but if they're starting to say, hey, we've got a plan of actions come out of this is the hit, then the recovery may well start to be there. But while it's still unknown, people are still cautious and people still don't want to lose money. That's their main priority, don't forget, guys. Making money is a main priority in most conditions. When you're in extreme conditions, the main priority flips from trying to limit losses, and then people are trying to make money after that. So thinking about that. This is the key one, guys. What happens after? So after you've had the bounce up, 3-day bounce, what's the response after that? If you're holding maybe for a couple of days at the highs, you can start to think perhaps sellers aren't that keen. Perhaps the liquidations ended. Perhaps that's the end of that little move and we're now going to wait and see if there's a next leg of buyers. And this is the key thing. It's the price response to breaking out of the range. It's the price response to a 4-day bounce, a 3-day bounce. What happens? Does it hold and just sit there and wait and see what happens? Is it a little doji the next day? Is there a little tickle higher or slightly tickle lower then reverses? Or does it get sold into straight away and reverses? Does it then have a big red day after that? In which case you might be able to frame it and go, well, it looks like a dead cat because there's no continued buying. People have literally been seeing this as an opportunity to sell at a much better price than they had a couple of weeks ago. So I think the thing to think about, guys, there's no holy grail. Of course there isn't. The thing to think about is, what would this look like if this now reversed? What would the chart look like if we now continued for another couple of days? Where could we potentially go to inflict the most pain on buyers or sellers? That's worth thinking about as well. You know, if you're thinking about, let's take the two scenarios. If you're thinking about selling into the dead cat bounce, you want to short to fresh lows, where could it go to make it look the most positive possible to suck the most buyers in? That's your short, not earlier, because the very nature of the dead cat is it bounces a bit, everyone sells into it, and then it rips a little bit higher and just turns a screw and it just flushes people out and then it rolls over. So you want to be thinking one step ahead, right? Where could it go that would make it look the most attractive at that point in time? And it probably is going to be like this kind of scenario, right? It's like broken out, everyone's excited, 3 days of rally, good strength, 1,000 points up, everyone's buying it, but you're thinking one step ahead and thinking, right, well actually, if the next day ends up down here, all of those are going to be trapped in it, every single one of them. So that's your dead cat bounce strategy. You're waiting to see the most extreme pain points to initiate your short. Not too early, because you're going to be then on the wrong side of it, feeling the pain as it rips up and you have no room to wiggle. You wait until it pulls up, then starts to pull down, and then frame the trade after that high. If you're trading for the recovery play, same kind of thing. If it's ripping up and ripping up and ripping up, what you don't want to be doing is chasing it, thinking I'm going to miss out. It will pull back, even if it has to go way higher and pull back. It's much better from a trader's perspective to be able to frame that trade using that logic than it is to chase it, then have to sit through pullbacks, thinking I've bought the high here, and not knowing and not having a real place to get out of the trade, it's far better to do that. So no guys, those are some of the things that I like to look for. Let me know your thoughts in the comment section below. What do you kind of look for in a market that's been absolutely hammered, whether it's the dead cat bounce, whether it's the start of a recovery? Have you got little clues that I've missed? Maybe you've got some specific indicators you like to look at. Maybe you like to look at distance from moving averages. I know some people like to look at, from the broad market, things like how many percentage of stocks are under their 200-day moving average. There's loads of different things out there. So let me know yours, comment section below. Appreciate your input, guys. And as always, you know what I'm going to say, keep your risk management. I'll see you in the next one. Take care. Bye-bye.